one company in focus here is Raymond Realty on the back of its first quarter results. Now, what we are looking at in terms of the key operational numbers is a dip of 50% in terms of how the bookings have fared out. Collections are down about 23%, but if you look at the total gross development value, that stands roughly at the likes of 40,000 crore, and the company maintains a net debt-free status with 233 crore in its net cash surplus. But to discuss more on the strategy forward and the outlook as well, we're joined by Harmohan Sahni, the CEO and MD of the Raymond Realty. Now, welcome, Mr. Sahni, to the show. My first question to you is about the key operational numbers that we are looking at. In this first quarter, while we've seen a downtick in terms of where the booking and the collection numbers are, want to understand whether it's whether new launches are skewed towards the second half, or what's the outlook over here?
Yes, the numbers that you have seen for Q1 are as expected. This is exactly what we had budgeted for in the first quarter. Naturally, the markets obviously try and compare the corresponding quarter, which is there. We have most of our launches bunched around H2, which is Q3 and Q4. Most of all our new JDAs that we have signed, which is in and around BKC, and that's a very substantial amount of inventory that we've got, will all be launching in Q3 and Q4. Also, last year Q4 was a bumper quarter for us. In fact, we had a 45% growth year on year last year, even though we had given a guidance of 20%. So we actually had to rush to get more approval so that we could launch more projects quickly. In Q1, most of the mature projects, we had very little inventory left. In fact, this is a problem of plenty that we have as of now. But as we speak, in this week itself, we will be launching inventory in Thana worth about 1,100 crores. So that's something which will give us good fillip in terms of, because we have a lot of pent-up demand, but we didn't have enough inventory which was approved for. So Thana will start showing results in Q2 itself, and then Q3 and Q4 we've got 3 to 4 launches in and around BKC. So the outlook is pretty good. We maintain our outlook of 20% growth year on year. The business is such that it doesn't really lend itself to quarter on quarter comparisons. But as far as our trajectory is concerned, the secular trend is very positive and upward for us.
Mr. Sahni, give us perspective about these launches that you're speaking about now of your own land bank of Thana particularly. You've sold about 40 acres and what remains is 60 acres, which will be executed over the next 7 to 8 years. And the JDAs that you spoke about, 3 to 4 of these to be launched in the next 6 to 9 months that we're looking at. So considering both FY26 and even FY27, if we have to take that in picture, what is the kind of gross development potential that you see from these projects coming in for these next 1 to 2 year period?
So as you rightly said right in the beginning in the introduction, that the numbers as far as GDV is concerned is about 40,000 crores for us overall, which will play out in the next 7 odd years, maybe 8 years, 7 to 8 years, all of it put together. Thana and non-Thana put all combined. Thana will probably take a little longer because that's a larger tract of land. And rest of these will happen over a 4 or 5 year period. If you look at non-Thana, the GDV is about 14,000 crores, and 14,000 crores over a 5-year period it will give you over the next 2 years. You can safely say almost 40% of that. Let's say about 6,000 crores should be introduced into the market over there very clearly. As far as Thana is concerned, we typically have been doing last 2 years about 2,000 crores worth of sale in Thana last 2 years. And we don't see that number changing significantly this year also, despite the Q1 where we didn't have enough inventory. But we have pent-up demand. There are people who are waiting to absorb the inventory, which is going to be launched just now. So we will catch up on that. So that's about run rate of about 2,000 crores per annum on Thana that we have. So that next 2 years, like you said, 4,000 over there, 6,000 outside. So about 10,000 crores worth of inventory should get absorbed very easily over the next 2 years for sure.
Right, sir, given the fact that you're expecting strong growth going forward, any guidance if you could give us on what should investors look at or what should investors expect when it comes to pre-sale? Any growth guidance for the next 2 years or 3 years on the pre-sales front?
So the guidance that we have given, we have been talking about it for the last few quarters also, is you should expect about a 20% year-on-year growth from us in terms of top line, and also you should expect about more than 20% ROCE from the company. So the returns will be pretty healthy, the growth will be quite healthy. And like I mentioned last year, even though the guidance was 20%, we gave a 45% growth. So we hope to do much better than the 20% guidance that we have given. But that's the minimum market can expect from us.
Okay, so that's in terms of the pre-sales guidance that we are looking at. But I want to also understand on pricing front, like if you look at the industry-wide phenomenon, we've seen about a double digit of an increase so far in the last 2-3 years. But now the expectation is that that is expected to stabilize. Just want to understand from you, what is the current pricing growth that you have seen and expect going forward in the next 1 year period? And with increasing competition also, do you see an impact on this pricing growth that we're looking at in the markets that you operate in?
See, the markets that we are in, we haven't seen double-digit growth in pricing, and we've been very disciplined in terms of what kind of growth we want to show in our pricing, because we believe for the market to remain healthy, prices should not run away very quickly and should not go beyond the affordability factor, because affordability is a very big thing in a product like real estate. It's a big ticket item. So it becomes very critical that the market remains healthy in terms of volumes should be good. And that will only happen if the prices are healthy. So over the last 3 to 4 years, we have on an average seen 5 to 7% growth in terms of pricing. And last year also, we saw a similar kind of growth in pricing. Going forward, current year as well, we are not expecting price growth beyond 5 to 6%, maybe 7%, and not more than that. So our experience has been that it's been a very healthy market in terms of volume and volume growth, and prices have more or less remained stable in the markets that we have operated in.
Okay, Mr. Sahni, so 7% is the kind of growth that we should be expecting. Just with that, you've currently maintained a net debt-free status, but with more project additions coming in, will you be able to sustain this? Just want to get your understanding on this.
So this year, definitely we will be taking debt. In fact, we have debt on the balance sheet even today, but we have more cash than we have debt. So on a
Right.
net basis, we are debt free in that sense. So going forward, that situation will change, and but we are going to be financially very disciplined, and we've taken a decision internally that we are not going to exceed 1:1 debt equity and 2:1 debt to EBITDA kind of metric. And that's something we will stick with. But I don't think in the current year we'll come anywhere close to it also, because the way our plans are and the cash flows have been very, very healthy. Internal accruals are pretty strong going forward also. When I look at my projections, and these are projections based on products which are already in the market. So these are proven projections and cash flows. We will definitely have debt, but it will be less than 1:1 debt to equity.
Well, sir, thank you, sir. Thank you for joining us and sharing more insights about the company.